I'm Janet Noak.
And I'm Andrea Dillon. We are a mother-daughter CPA firm serving the United States business community with tax preparation services, tax planning, tax resolution, assurance and audits, and CFO outsourcing and consulting.
Thank you for listening to the WOW podcast, Words of Wealth from CPAs of Florida. Learn more at cpasofflorida.com or call us at 239-936-6144. Today we're going to talk about the gotchas of getting married or getting divorced during a tax year and what might be advantageous to make it a little bit more tax beneficial to you. Andrea, I believe you had a case where you wanted to talk about whether or not to sign a joint tax return in the process of a divorce.
I do. So typically when people are getting divorced, but they're not quite divorced yet, as of the last day of the year, December 31st, that means that they have to file either married filing joint or married filing separate. Whatever you are on December 31st is what the IRS says you are for the whole year. So even if you've been separated for the last few months, you may not even be speaking to each other anymore, but because you're legally still married, you have only those two options. So what happens so often is that one of the spouses, the one who handles the taxes, is typically pushing to file joint because usually it works out better. Well, when things like alimony and child support are being brought up and finances are being scrutinized and money that can be reallocated or hidden is happening, that comes into play with the tax return as well. And if you're signing a joint tax return with that spouse who's technically still your spouse, you're accepting all responsibility for all the numbers on that tax return, not only that they're correct and accurate, but that you're going to pay the tax due. And even if you have a verbal or a court agreement that your to-be ex-spouse is going to handle the taxes, you usually don't have a joint bank account at this point anymore, and you can't actually prove that they paid the taxes. So it's really a risky maneuver, and you're placing a lot of trust in somebody that you're trying to divorce. So I had a case not that long ago, about a year ago, where a woman was in the middle of a divorce, but she was still getting divorced. So they chose to file married filing joint, and they were at a place in their divorce where they were not communicating much at all. He handed a tax return to her, she signed it without reading it, and it actually included a fraudulent refund claim for $97,000. She signed it, IRS got her involved, got him involved, they froze the refund. He actually went down on criminal charges. She only got out of the criminal charges because she testified against him in court as to some of the nature of their financial lives or whatnot. And she ended up on house arrest for 6 or 8 months, plus she had to pay a $50,000 penalty for a frivolous refund, all because she signed a joint tax return that she really didn't understand. So it really is a big deal when you're getting divorced, and things like that do happen. That is an extreme case. However, I don't know about you, but even if it was $10,000, not $50,000, I'm not sure that I want to take that responsibility for someone I'm trying to legally separate or divorce from. But I mean, also on the flip side, when someone is getting married, there's things you got to think about outside of the happiness and the butterflies on that side too. So Janet, I think you had a tax return this past year, a case where someone got married and forgot to reach out ahead of time and they had something happen, right?
I did. I had a situation where a client got married in December, the end of the month, the holiday wedding, all the excitement of the holidays. They thought they would throw a marriage into it. The wife was a student, the wife-to-be was a student and was receiving a large healthcare subsidy, which meant that once she got married and the husband was making more money, that she actually had to repay that healthcare subsidy. So they didn't talk to a CPA before they actually set their wedding date, and they didn't consider this. Ended up costing them thousands of dollars in subsidy repayments. It could have been avoided if they would have just got married the first week of the new year. So as Andrea mentioned, your marital status December 31st is your marital status for the entire year. So the IRS doesn't care whether you got married New Year's Eve or whether you got January 1st. Either way, you're married all the way through the year in their eyes. So in this case, they could have avoided thousands of dollars in a healthcare subsidy repayment by just pushing the wedding off 1 week. So that is something you need to consider when you're setting a wedding date, which is the exact opposite of what Andrea was talking about. Andrea, any final comments on this topic?
Just that when we're talking about falling in or falling out of love, whether you're getting married, whether you're getting divorced. Usually talking to your CPA is not high on your priority list, but it really should be, because in both of these cases, there were tax effects that could have been mitigated or could have been avoided if each of these clients had just had a simple conversation. So if you are one of these people and you have questions and you don't have somebody to consult, we would love to help you. You can reach us at 239-936-6144, or of course you can look us up at www.cpaoflorida.com. Again, my name is Andrea Dillon.
And I'm Janet Noak, and we are CPAs of Florida.